Hi everyone, welcome to today's video. So on today's video, I'm going to discuss with you 5 stocks. Now these stocks have fallen quite aggressively from their peak. These are very volatile stocks. Point number 3, that the entire market is divided into 2 camps. One camp is saying that, you know what, these stocks have corrected by 50, 60%. So let's go and buy them and they are likely to become multi-baggers and we are getting them at a deeply discounted prices. The second group is saying that, you know what, these were bekar stocks, fuddu stocks to begin with. Therefore, they fell in the first place. So why touch them? So which faction is right? I'm not here to debate that. I'm simply here to present my analysis on these 5 stocks very quickly so that you get a basic perspective as to what you need to do. Please do your further research on this topic. If you need further help with research, you could consider joining my YouTube premium member community. Here, I speak about specific moves that I'm making. If I'm buying certain stocks, I will speak about it. If I'm selling certain stocks, I will speak about it. So this is an entire investment community that we have built over time and it is getting a lot of positive feedback. So you could consider joining it. Now over to the main video. So let me start quickly discussing 5 key stocks. The first key stock that I'm going to speak about is the Adani Group of stocks. Now many of you would say that, you know what, Akshat, हाथ धो के पीछे पड़ गए हो, you are after Adani Group. No, nothing like this. The reason why I am bringing up Adani Group of stocks again is fairly simple because the entire Indian market right now is revolving around the Adani Group. When Adani Group moves up, the Indian market moves up, and when Adani stock falls down, the Indian market falls down. So in order to understand the Indian market sentiment right now, you have to do a very quick analysis on the Adani Group of stocks. So the first key point that you need to understand about the Adani Group of stock is that these stocks are trading either in upper circuit or lower circuit. Now, what is the meaning of upper and lower circuit? For that, let me demonstrate an example about Adani Green Energy Company. And here what you would see is that it kept on falling in a very linear fashion. Now, if you go and check its 5-day history, what you will notice that it is moving in this stepwise format, that it was here, then it went up, then it's plateaued, then it went up, plateaued, went up, plateaued. So whenever you are seeing that something is happening in a step format like this, or if something is falling again in a step format like this means that this is a circuit stock. Now, how is this important? This is something that normal retail investors need to understand. So again, let's open the 1-month window for Adani Green stocks. And what you would notice is that this was actually consistently in the lower circuit. So this is the depiction of 30 days, right? So here, there was constant lower circuit. So let's say that you bought Adani stock somewhere around, let's say 800 levels. You thought that, you know what, काफी correct हो गया है. Let me buy it here. And you purchased it. Now, next day when it fell by how much percent? So every day it kept on falling by 5%. So next day it fell by 5%. Then next day it fell by 5% again. Then it fell by 5% again. Now you're sitting on a 15% loss. You're thinking, यार गलत खरीद लिया. बेच के निकल जाना चाहिए. I should sell it and move on. Then what would you do? You will place the sell order on the stock. But the problem is that if it is a lower circuit type of a stock, the chances are that your stock will not get sold. This is a very important point that you need to understand. Just quickly recapping, what you need to remember is that, see, if you would have purchased it at 800 and the stock fell to 700 also, and you thought that, okay, now I will exit the stock. Even if you want to sell it, you might not find counter buyers. So this frequently happens in a circuit stock. Now, what is happening in the Adani Group is that the market sentiments have improved and the stock has started to scale up. And now it is getting into upper circuits. So now what is going to happen is that, let's say that you purchased Adani Group of companies here, and from tomorrow, if lower circuit comes, then again, you might enter the same problem that I was trying to exhibit earlier. So this is the first key point that you need to understand, that many of Adani Group stocks are existing in a lower or upper circuit. And if you as a retail investor try to touch them, you can get burned very badly. So this is the first key message that I would like to give you. The second key message, and I'm getting a lot of questions that, you know what, fundamentals of Adani Group, has it become better? Has it not become better? See, I don't know and neither I am going to comment. But a thing that I know for sure is that Adani Group of companies are family owned, family operated and family controlled group of companies. This is not me saying, this is a shareholding pattern that you can take a look at. Again, I will put the chart somewhere here and you yourself will be able to make out that Adani Group of stocks are family owned, operated. There is a separate video that I had done. If you want more fundamental understanding about the group, please go and watch that. I will put put the links in the description box. Now, knowing this fact is very, very important. Now, why is that the case? Let me explain that by using a simple example. So let's say that you're very bullish about Adani ports. You think that, you know what, fundamentally it is good, this, that analysis I've done. Now I want to buy Adani ports. Yes, you go and buy it and maybe it starts running also. But what is the guarantee that whatever profits the Adani ports is making, it will one way or the other might not get diverted to Adani Green. So this is the precise problem that happens in conglomerate stocks. So you need to be aware of that. That debt can be intertransferred, the profits can be intertransferred. A lot of funny accounting stuff can happen. Now, I am not trying to portray the fact that you should buy, not buy Adani Group of companies. That is very well your wish, whatever you would like to do. I frequently get a question that at what levels will I buy Adani Group? So the answer is at no levels I'll be buying Adani Group. Why? Because I might be doing analysis for this. Then how can I be sure that the money will not get diverted to this? So for that particular perspective, I will stay away from the Adani Group. Now comes the third and final point, and it is a very, very important fundamental point which has to do with the interest rate. You might have recently read the news that RBI is planning to hike the interest rates by 25 basis points. Similarly, the US Feds are planning to increase the interest rate. Now, why am I bringing this up? Am I trying to scare you about the interest rate scenario in the world? The short answer is no. I'm not trying to create fear mongering. What I'm simply trying to tell you is that right now the interest rates have already gone up and they are still in the process of going up. One day these will plateau and then they will start falling. But in this entire zone here, when the interest rates are going up or will remain high, what type of companies will suffer the most? So you guessed it right, that companies that have very high debt are going to suffer the most. Now you'll say that, okay, you keep on saying every time that Adani Group, high debt company. Can you talk about some other company? Yes, I can definitely talk about some other company, and that company is called as Vedanta Group. And it is somewhat struggling with this same interest rate issue. What is that issue? It is the fact that they are unable to refinance their debt, or external investors are saying that, you know what, Vedanta Group, you have so much debt lying on your head, and where will you get the funding from? And even if you are able to do it, you will be spending crazy amount of money just repaying the interest that you have taken from the market. Again, the story lies here that the interest rates right now are very, very high. Again, here is a chart for you. You can check that how high the interest rates currently are. And it might very well be the case that for the next 1.5 to 2 years, companies like Adani and Vedanta, which are very high debt companies, they are going to suffer a lot. So back to Adani Group, that will I be buying Adani Group? The short answer is no. Again, please feel free to do whatever you feel like, but please explain your rationale. I would love to hear contrary commentary. And again, the type of investment community that we are building, everyone would appreciate each other's viewpoint. The idea here is not to fight with each other, but to present contrary opinions so that everyone can learn and form their own mind as to whatever they should invest their money on. So with that said, let us move to stock number 2 and let me detail out the conversation around the Vedanta Group. So first things first, people who are not familiar with the Vedanta Group, let me quickly explain the business model. First, they were the mining barons. So a lot of mines they had in Goa, a bunch of other different parts of India, and they used to be in the mining infrastructure domain. Then they switched majority of their business to oil and gas. So basically Vedanta Group is into a series of different type of businesses which has to do with mining and oil and gas. They have a very large exposure to the commodities market. Now what is the meaning of commodity? For example, aluminium, you have coal, you have oil and gas. So all these are what? These are natural raw materials which is used across different industries. So here are a few salient points that you should know. First and foremost, commodity market saw a massive boom cycle. Why? Because of China. Why China? Consider, for example, that the Chinese real estate market used to use the most amount of steel that was consumed all across the world. So that was a major growth trigger for the steel market, aluminium market. And again, whenever real estate develops, you would need different types of mineral components. So China market was driving the commodity prices really, really high. It was developing the real estate market. It was developing the infrastructure market. It required a lot of energy. So many of the oil and gas company, copper, aluminium type of companies, they were benefiting from the China's growth story. But unfortunately, after 2012, there has been lackluster performance in China. The China's export market is suffering. Internally, their real estate market is suffering quite aggressively. And that is where the bad story of Vedanta Group starts, that they were a pure play commodity type of a company. And because of the slowdown in the Chinese real estate market and bunch of other internal consumption markets of China, Vedanta also suffered quite badly. Now the second problem that the group suffered, it was very simple, that the interest rates are very, very high. And if the interest rates are inching the last almost 6-7 years high, then it becomes a bad scenario for an infrastructure driven company. Now when it comes to Vedanta, when it comes to Adani's, what do they need? They require massive amount of capital. where will they get this capital from? They will get this capital by borrowing money. And whenever they are borrowing money, they will have to pay a rate of interest on that money. For example, right now, if you have a home loan, it might be inching towards 10%, which is very high home loan rate. So to cut the long story short, all these very heavy infrastructure driven companies, and they need to borrow it. And whenever they are borrowing capital and whatever the rate of interest during that time is, that defines the short-term prospect of that stock. Which brings us to the third key trigger and third key problem with the Vedanta group of company, which they are having issues in terms of interest repayments, and a lot of international organizations are sort of not sold on the entire Vedanta story. Now, just for example, Moody's has done an analysis and they are saying that this is the amount of external debt that the company has, and it can face a lot of cash crunch and refinancing crunch in the economy. The final reason here regarding the fall of Vedanta stock is that the government itself is not very happy and it is in a war with Vedanta. The entire issue stems from the fact that Hindustan Zinc, which is a company and it is a venture between Government of India and Vedanta, and what Vedanta does is that it also runs a sister company. Now Vedanta, what it is trying to do is that it is trying to sell its sister company to the Hindustan Zinc, which is jointly managed by Government of India and the Vedanta Group. Now this is causing serious worries and the government has asked SEBI to look into this. So this issue is blowing up and there is less clarity on this entire topic. Someday some positive news comes, the stock gives a massive run up. Someday negative news comes, the stock falls quite aggressively. So talking about my verdict on the stock, will I be investing in it? The answer is no. I will not be investing in it simply because of the viewpoint that yes, the stock has corrected quite aggressively and it has been correcting quite aggressively, but at no level you should be investing in companies where fundamental clarity is not there as to where the business is going to head. And if it has serious macro issues, for example, repayment of debt or interest rates are going to continue to hurt these type of companies, then generally my particular suggestion would be to stay away from such stocks. Okay, so the third stock is Zomato. So here is my updated perspective on Zomato. Let me quickly explain you the fundamentals, but let me very quickly touch upon the technicals first and how much the stock price has corrected. So here you can see that the stock price has corrected quite aggressively by approximately 70% from its top. And when was the top made? It was made almost at the IPOing time. Since then, Zomato has taken a massive beating. Now, is there only negative news only, or is there some kind of positive that we can observe? So the thing is that in startups where profits are not there, for example, Zomato is not really a profitable company. Yes, their revenues are going up and up, but their cost is also rising. So therefore, it is not a profitable company. It is a growth story driven company that people buy Zomato stocks because they believe that, you know what, aage chalke Zomato is going to make crazy profits, and therefore if we buy it now today, we will get it at a very good price, and aage chalke we might be getting it at an HUL type of a price. So this is a growth story stock. Now see, there is nothing massively wrong with this as long as you are getting it at the right price and you are clear about the business fundamentals of the companies. So let me explain that very, very quickly. But point number one that you need to notice that these type of companies usually go through a price discovery process. Now, what is the meaning of price discovery? It simply means that the firm IPO'd here, then it danced around, consolidated, then it went up a little bit, then it fell, and then it started consolidating. So this could be considered as a major consolidation zone for the stock. It has been almost 1 year. So this is April data. What we are looking at here, this is April, and this is almost March. So in this 1 year, the stock has been consolidating in this price point. Now, no one can say for sure that what is the correct price of a stock. But what we can definitely agree on is that for the last 1 year, Zomato stock has been consolidating in this range of 70 to roughly 47, 48. So this is the range where you are getting the stock. Now, please understand that in the last 1.5 years, the market sentiments in the Indian markets or overall, even in the world market, has been really bad. So if a particular stock like Zomato, which goes through a price discovery process where almost 70% correction of the stock has happened and it has been consolidating for almost a year, this becomes a very strong consolidation zone. This is the key point that I would like to establish. So what does this simply means? That it might very well happen that Zomato corrects a little bit more or maybe like 20-30% more, who knows, but it is very likely that it will revisit this zone very, very quickly. Or it might also happen that once the market starts giving a run up, Zomato becomes like a very, very strong, that becomes a multi-bagger, so to say. Now, to understand that and evaluate that, you need to understand the business changes that Zomato is making. So the first key change that Zomato is making, that it is focusing less on its 10-minute delivery model. This is a very important change because up until 6, 7, 8 months back, everyone was talking about 10-minute delivery ho jayegi, and everything will be good, this, that. But that 10-minute delivery thing is done and dusted to a very large extent. We can all have our opinions, but the 10-minute delivery model was not a very profitable thing. It was a cash burn. But unfortunately or fortunately, the VCs have started telling the companies like Zomato, and VCs were investors in Zomato. So they started telling Zomato, bhai dekho, profitability dekh lo, don't burn your money. And this is the same message that has gone out to almost all these startups. And all these startups are now trying to run that profitability race rather than mad expansion race. Second thing, what they have started to do is that they have started focusing on their core business. So again, I will link Zomato's case study in the comment and description box. You can go and watch it. That will give you a better sense about Zomato's business model. But for this video, you need to understand the very simple fact that Zomato is focusing elsewhere. Its core business model is number one, marketing, that it makes a lot of money through the marketing platform that it has. What is the marketing platform? The app itself, that hotels or restaurants who are getting featured on Zomato, they pay Zomato a lot of money to get featured so that they get more visibility and more business. So that is their first key model that they are looking at. And second is the delivery partner model. So there Zomato has almost 50% market share, which is fairly substantial. The other 50% would be owned by Swiggy. So this is a split market, so to say. So the logistics market is figured out, but the ad spend or marketing market is where Zomato is aggressively focusing right now. And the number one announcement that they have made is that they are asking the restaurants now to keep a budget of at least 5% for revenue generations by giving marketing budget to Zomato. So this is a big number that now what Zomato is saying that, you have to give us 5% of your marketing budget, whatever sales we are helping you generate. So in a way, we are taking 5% stake in your company, like automatically in one stroke. On top of this, they will charge like delivery fees. They might do like Zomato Gold, whatnot. So there are multiple avenues through which Zomato can turn profitable. Now, keeping this viewpoint in mind, there is a lot of positive commentary that is happening with Zomato's stock. For example, this research report here has given it a price target of 74 rupees, which is a substantial jump from where it is currently trading. Again, this is not a push that you go and invest, go don't invest. I'm just simply helping you understand the model that for the time being, it looks like that Zomato is actually trying to play the profitability game. They are focusing on their core business. They are expanding into interesting things, no doubt about that. And they are also trying to burn less money by avoiding businesses like 10-minute delivery and whatnot. So this is the overarching viewpoint that I will give. So for me also, I would see the stock rising to roughly 74. So this is the target that I also have in mind. I will update more on the members community section. So now let's move on to the fourth stock, which is the somewhat of a brother of Zomato, which is Paytm. So Paytm also suffered somewhat of a similar fate to Zomato, that it got listed, got crushed by 70%, and every day it was a bloodbath. So let me very quickly talk about some of the investor sentiments on Paytm very quickly by showing you some snippets. So point number one is that Macquarie Research has given a target for Paytm at rupees 600. Right now the stock is trading at 450 rupees roughly. So this is a substantial jump that they are predicting. Will it happen? Will it not happen? Let me give you my commentary. Now, Goldman Sachs have also given it a very positive commentary that they are seeing the target price at 1150 rupees. Also, if you consider the shareholding pattern of Zomato, you will see a slight uptake in the DII holding of Zomato. So DII are domestic institutional investor. These are big investors from India, for example, AMC companies, mutual funds, is that. And FIIs also haven't really reduced the stake. So everything looks hunky-dory. Then why is it that people are getting tensed about Paytm? This looks like a great buying opportunity. Should you do it? Should you not do it? Okay. So here is the counter argument. So counter argument one. So their lead investor, which is the Ant Financial Group, it plans to exit the Paytm stock. When it is going to do that, I don't know, but they are very likely to do that. Now, rationale has also been explained, and the rationale that was given was that Paytm has actually done a lot of stock buyback. When the stock has fallen quite aggressively somewhere around last year, 197 Communication, which is the parent group for Paytm, it had purchased its own stock. Now you'll say that, okay, this is actually a good sign that the stock fell and the company purchases its own stocks. So it shows positive intent. It shows that they are believing in their own company. So yes and no, because sometimes these type of moves are made just to arrest the fall. That since the company does not want the stock to fall more, because what is going to happen? So imagine that there are 1000 stocks. The company ends up purchasing 100 stocks back. So what will that do? That will stabilize the other 900 stocks. Otherwise, the company might end up in a very big soup. So from that perspective, don't read too much into it that they had to do a lot of buyback. Was it a good move? Was it not? It's highly complicated. So let's not go there. But the argument that is given here is that, you know what, Ant Financial is going to sell the Paytm stock. Why? Because they had already purchased quite a lot. Now they have to put it on a block deal and sell it off. That is going to lead a little bit of fall for Paytm stock subsequently in the future. It might happen in 1 month. It might happen in 3 months. No one can guess. Now, a couple of more issues. One has to do with business fundamentals. Now, if you take a look at the business of Paytm, their primary business is still the wallets business and all this stuff. This is not a money-making business. For example, Paytm does a lot of transaction from its payments wallet, so to say, or in terms of making payments. But the take rate means that how much money the company is making from those transactions. The volume of transaction might be 10,000 crore. But if the company is only making 1 crore or 5 crore from it, it is not a very high profitable business, so to say. Then comes the banking thing. Now, the banking license has been given by RBI. Then some changes were made to it. RBI stopped Paytm from doing certain type of business. There was a lot of hoopla that was there. The area where Paytm is doing well is the wealth management arm. For example, when it comes to mutual funds, equities, and you might have also seen it that you can buy all this stuff from Paytm's app also and invest in mutual funds. So that business for Paytm is picking up. But the problem is that the entire stock market itself is going down. So the mutual fund industry is not recovering as of now. Maybe it will recover in the future and maybe that will help Paytm. But that again becomes a little bit of a timing issue. So none of the arms that you are seeing for Paytm, it is churning money, so to say. Mr. Vijay Shekhar Sharma is of the opinion that Paytm will turn profitable very quickly. That remains to be seen. But as of now, there is a lot of volatility associated with Paytm. And even if from a core business perspective, we cannot point our finger and say that, you know what, this part of Paytm's business model is going to become like golden. So please remember that point. So my verdict on the stock would be that yes, the stock has fallen quite aggressively. It is getting to a point where it might not be a bad idea to acquire it, but I will still wait and watch. Now comes the final stock. I'll be quick here, otherwise the video will become really big. So the final stock I'm going to talk about is Tata Galaxy. Now Tata Galaxy is actually a good company and it is into 3 different streams, so to say. So the first key thing that Tata Galaxy does, it does industrial design. Second, it does is embedded product design. And third is the software applications associated with it. It gets clients from primarily 2 industry. One is the healthcare industry and the second is the automotive industry. Now the problem is that both healthcare and automotive industries are both struggling. Both have a ton of inventory that is sitting on their book, and you might have seen that companies like Maruti, they have not given even 1% return over the last 5 years, 0% return. So it's a problematic situation in both these companies, and as a result, Tata Galaxy stock has also taken a nosedive. Now the business update with Tata Galaxy is very simple, that it has categorically mentioned on its report that it is going to move a lot of this product design business into industrial design business. Now, the industrial design business is a more profitable business. Now, let me take you to the profit and loss statement. What you will see is that, okay, the sales are going up. That is wonderful, no doubt about that. But more interestingly, the profit margins are going up. For example, that these profit margins are better than the pre-COVID time profit margins. So from that perspective, what is happening with the company is that the company is deliberately trying to shift its business to industrial design business. This becomes the money-making arm of the business. Also, the stock is available roughly at 40% discount, and it has been consolidating for the last several months, almost like 7-8 months have happened, that the stock has been consolidating in this particular range. So my game plan has been that I've started to aggregate this stock a little bit, and going forward, I will continue to aggregate this a bit more. This is fresh positions for me. So whenever I'm buying more of this stock, I will make community updates. Now, the major risk with this company right now is that the industrial design business that I spoke about, that is a highly competitive business. Now, Tata Galaxy is not just going to have competition from within India, it is also going to have competition from outside India. But the good thing is that the company is preparing for it. For example, it has done a partnership with Panasonic, which is good. Second key thing is that almost all the geographies, be it Russia, be it China, be it India, they are becoming slightly more localized. So the Indian government is going to protect the local manufacturing base, and a company like Tata Galaxy actually benefits from it. So this is the perspective with which I would be operating in the stock market. I hope you enjoyed this video. If you did, do let me know in the comment box and do press the like button, and I will see you very soon.